I'm Nate Lind, the online business broker who spent far too many late nights reading financial statements while everyone else watched Netflix. Today, let's talk about something almost as thrilling as binge watching your favorite show. How to value a company using comparable company analysis. I know, it doesn't exactly sound like the wild Saturday night you've always wanted, but trust me, once you know this, you'll feel like the Sherlock Holmes of business valuation. You'll solve the mystery of a company's worth quicker than I can say pass the spreadsheet. Comparable company analysis, or comps if you want to sound like you're part of some secret finance club, is basically the idea of looking at similar companies to figure out what the one you're evaluating might be worth. It's like looking at the price of one avocado at your local grocery store, then checking 3 more grocery stores so you don't get ripped off. Except instead of avocados, we're dealing with businesses, bigger, juicier, and hopefully less squishy. Here's how it works in a nutshell. Step 1. You find publicly traded companies that are similar to the one you're trying to value. Similar industry, business model, growth stage, etc. The closer the match, the better. Step 2. You collect their financials. Things like revenue, EBITDA, and that, but super fancy acronym EV for enterprise value. Step 3. You calculate some lovely ratios, like enterprise value divided by EBITDA or price to earnings. Don't worry, you don't need a secret decoder ring to understand these metrics. They're just tools to compare how different companies are priced by the market. So, let's say you find a handful of similar companies. They might trade at an EBITDA multiple of 5 times, 7 times, maybe even 10 times if they're really hot. By looking at these multiples, you can ballpark how to calculate business valuation for your target company. If your target company's EBITDA is $1 million and the comparable companies average 7 times EBITDA, guess what? We have a ballpark value around $7 million. It's not a perfect science. More like educated guesswork with a side of seasoned intuition. But it's a strong starting point. Now here's the kicker. You don't just pick one metric. You take a few, enterprise value divided by EBITDA, price to sales, price to earnings, and see if a pattern emerges. Sometimes one metric says $6 million and another says $8 million. That's okay. You can find a comfortable midpoint or lean towards the multiple that best fits the company's stage and growth prospects. Don't forget that public companies are generally worth more than private companies. So if you use publicly traded companies' data and apply that to a private company, it will be higher. So you need to apply a discount, of course. All this data wrangling and number crunching can be a colossal headache. That's why I'm here. I've helped countless entrepreneurs figure out how to value a company they built from scratch. And I'd be happy to help you do the same. Whether you're buying, selling, or just curious what your baby is worth, I'm your guy. My business valuation services are designed to make this process smoother than butter on hot toast. Before I let you get back to your day or Netflix binge, don't forget to subscribe to my channel and like this video. And hey, I'm feeling generous. Check out the description below for a link to get a copy of my book, Maximum Exit, which covers my valuation secrets and more. If you have any questions, or if you're ready to take the plunge and get a professional valuation from me, contact me today. Let's unlock the true value of your business together.